connection. So on the profit, when we talked earlier about the operating profit and other income, so that is kind of the profit that's above the line. So assuming you came in and paid cash, this would be the profit. So that's a profit number. Profit's always something that's hard to get our arms around, and of course we make our distinction between economic profit and accounting profit. All right, so cost of capital. What is the price that we're going to pay, or that we're expect to pay going into this project? So we have a blending of the two interest rates. 20% of the money, the investors are expecting a 15% return. So their rate of return that they'd like to get is 15%. 80% is going to be at the bank rate of 5.5. We add those two numbers together, that averages out to be an effective cost of capital of 7.4%. So we call this the weighted cost of capital, the WACC, because all we've done is we've weighted it by the amounts that were different in the loan process. Okay, any questions on that? So now Mr. Matthews is looking back at this thinking, well, how much am I willing to pay for this building? Because he hasn't bought it yet. Should I buy it? Should I not? This is what I'm facing going into it. How many of you have heard of a cap rate, capitalization rate, maybe from an old class? I won't even pick on you to tell you what it is, but you had to remember that word. Does that sound familiar? Skylar, does that sound familiar? Capitalization rate. All right, so that's kind of one financial ratio or one financial tool that you use to estimate value. And the gist of it is that if you're expecting to get 7.4% rate of return, what's the most that you could pay to get $550,000 worth of profit, right? So we're kind of working backwards into the situation. The building pays out $550,000. That was the profit that it does through operations. And we need it to earn a 7.4% of whatever we pay for it. So if we work the numbers backwards, notice if I take 7.4 million times 7.4%, if somebody could do that for me, pull out your calculators. 7.4 million, and you could just do 7.4, times 0.074, 7.4%. 5476, so pretty close to this, right? So $550,000. So all we've done is we've used the capitalization rate. So let's write out that formula to estimate value. Okay, so let's just call this one way to think about the relation of return rate of return and price. And I'm going to do this a couple different ways for you because we kind of go back and forth. If I take my $7.4 million price that I paid for the building, and I show that, and I screwed up the way I showed that. I should have put 550 first. If I take my $550,000 profit divided by the purchase price of 7.4 million, I earned $550,000 by buying a $7.4 million building, right? So that was my profit off of the purchase price. That gives me my rate of return, or kind of like an interest rate. So rate of return. And in this case, I guess I should have put the number since we were doing that. Approximately 7.4%. Which maybe is a bad number since we had 7.4 million. So the formula would look like this. The return divided by the price of the asset equals the rate. What we did with this problem was just used a little bit of algebra to switch this around. I wanted to figure out how much I should offer this person for a price. I didn't know the price, so I just made it look like this. I took the price, put it over here, put the rate over here, and I took the return divided by the rate, which was the weighted average cost of capital in this case. So this rate, and I'm kind of using generically the word rate, the way I've got this drawn here is the capitalization rate. Whoever came up with that, I don't know who to give historical credit to, but that was the capitalization rate. All right, now this gives rise to relationship between interest rates and bond prices. If I'm pushing on anybody's knowledge that took a class way back when, how are those two things related to each other? Interest rates and bond prices. As interest rates go up, the price of bonds goes down. Good. I had more than one person, at least 3 of you had at least some up arrows or down arrows going the right direction. So there's the inverse relationship between the interest rates and the price of bonds. They move in opposite directions. Well, that's exactly what's going on here. So as the price of a bond goes up, the denominator's getting bigger, the downstairs is getting bigger, the overall expression has to, by definition, be getting smaller. So that's all we're doing here. That's the price of an asset, in that case would be a bond, is getting smaller. We're just plugging in real estate now as our asset. But the same thing is going on. The more I pay for that building, the lower my rate of return is going to be on that building. If I pay $10 million for the building, and we do this calculation, the effective rate of return is going to go down, right? So, inverse relationship between asset prices and the effective rates of return. Okay, so what did you come up exactly with this calculation? Okay, so how would we decide what's the appropriate amount to offer? Should we offer more than 7.4 million? No. So this is the break-even kind of price is what we did. We kind of backdoored it and came up with, okay, 7.4 would be the absolute most. If I can get it for less, maybe I would. But maybe this isn't the best deal in the world. All right, so from this particular story, he did not buy the building, and it turned out to be a good decision in hindsight. The building was 90% occupied. Income dropped to $500,000. And then the financial crisis hit, and banks are now loaning at higher rates and lower loan-to-values, and that's part of why I'm teaching. So in a nutshell, there's the financial crisis. You can't get money out of banks that are crippled by the system. All right. So questions on that at all? This last calculation is just kind of plugging those numbers back in. If the deal were done today and you needed to come up with more capital. By the way, what happens in a commercial deal like this is they might give you financing for 5 years, and then after it balloons, they would ask you to recapitalize it if rates are different. So they might say, hey, sorry, Bert, things look good there at 80% loan to value, but now we'd like to see you at 65% loan to value. So if you could just bring us $1.5 million or so, that'd be great. Yeah, sure. No problem, right? So ends up being a bit of a problem, and that's exactly what happened on a smaller scale on individual homes and on a bigger scale in the commercial markets. I mean, so this happened across the whole country in 2008. That exact same concept, the tightening of credit, as well as the prices due to the recession. Okay, questions or comments on that? All right. So who's the borrower? Who's the lender? So the discount rate is kind of your opportunity cost, another word that can be used for that. So if my opportunity cost is 10%, would I lend or borrow from somebody with an opportunity cost of 15%? Who's the lender? Who's the borrower if your opportunity costs are different? Okay, good. So the lender would be the lower one, right? So if the best they can do with their money is 10%, then if they could get anything higher than 10, they'd be getting a deal, right? And for the 15% person, if they have opportunities that can get them 15%, and they can borrow funds at something less than 15%, then they can make themselves better off. So we've kind of got a market here that's driven by opportunities available. Now that's maybe different than you thought about it before. You just thought, oh, interest rates, well, it's whatever the bank says. You go in, talk to the lender, and yeah, different banks have different amounts, but why? Well, this is really what's driving it underneath. This is the real economy going on. There's people with opportunities out there. If they think they've hit the jackpot and they've got something that they're going to double their money in a year because they've got this new great invention and it's going to be awesome and blah, 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 well, they'll be foolish probably, but they might be willing to borrow on credit cards and go 30%. They're like, oh, it doesn't matter if it's 30%. We're going to make so much money. We'll just pay it back later, right? So again, these the real economy is driven by opportunities of what people can do. In an economy where people don't perceive there to be opportunities, then interest rates start to fall, right? And that's kind of what we're in now, where we don't expect that it's going to be very profitable. And so it's hard to get people to borrow money because they're fearful of what they can do or what the future's going to bring. Okay, anything else on that one? So that's how markets are born. What are people's opportunities? And you know what's awesome about entrepreneurs is that they're opportunity seekers, right? They're always trying to stay alert to the market circumstances, like, oh, well, what if we did this? And kind of using imagination and creativity of, well, what if this went together this way? And then could we sell that? Well, maybe we could, right? And so you're always kind of pushing for other opportunities, and that is what a famous economist, Joseph Schumpeter, called creative destruction. There's people out there, those entrepreneurs, that are always looking for something better, right? And by doing so, they destroy the old. Creative destruction. Something new comes in and the old gets destroyed, and that's the real economy. Not really ever maybe coming to some magic equilibrium, but always a work in process, always churning, always going, something new. All these opportunity seekers finding something new. People think they're crazy to borrow funds at 14% to do that project, but they don't think they're that crazy because they think they've got some new information, a new novel idea. And if they're fortunate enough to sell a few investors on it, and they don't have to go to those banks that aren't willing to get their money out, but they got private investors because of their secret sauce that they got to solve some world's problem, then they do it. Creative destruction. Economic progress, wealth creation. Kind of the bottom line to what we're talking about in this class. Okay. So now that you guys are experts on capitalization rate, this little guy here, now we get to put our big boy and big girl pants on and talk about net present values and internal rates of return, all of that stuff you got right off the top of your head. Let's see, I'm trying to think. Skylar, did you have me for class in one of my lectures on this? You just had macro, right?
Yeah.
Did you even have micro? We don't really do net present value in micro too much anymore. Micro typically, but it used to be macro, so when you took it, it might have been macro. Okay. All right, well, how do we take time into account? This was pretty simple analysis, somewhat naive actually, right? If I buy a $7.4 million building, do I place all of my valuation on the first year's profit? Is that the only thing that gets considered? No, right? Unless you're going to sell it, but usually with real estate, you're going to hold it longer. Well, what's it going to do the next year? Well, I think it'll be due another $550. What's it going to do the next year? Probably $550. But then there's this new factory that's being built in town and Army base that's coming in or whatever, and I think our revenues are going to go up to $750. But that's not till year 3. So how do I start to handle time into the equation? All right, so what do you think? Net present value, future value. Who's got that formula that can help us out here? Who's got that one? Overland Park, you got that one? Just mostly hearing silence. There must be a problem with our audio system, I'm guessing, or... All right, so let me characterize this a little differently. Let me play off of this. I'm kind of going off the cuff here, so bear with me. So let's take. I think I'll make it a little bit smaller numbers here. So let's take 740. Let's take a $74,000 rental property. Let me just chop off a few zeros instead of 7.4 million. And let's see here. Let's have $5,500 come in after the first year. Let's have $5,500 come in year 2, and then in year 3, we get our 550 or 5,550 plus we sell the building for 75,000. So, was it a good investment? You guys see that board okay? Okay. So was this a good investment? What goes into determining, was that a good deal or was that a bad deal? Did that suck or was it awesome? Let's take baby steps here. Who can tell me something about that timeline?
Well, how much did you have to, how much were you having to pay back investments to make the original purchase?
Let's just say you paid cash.
Okay. So what were the current interest rates?
Okay, why do you say that? I'd agree. Current interest rates, where are you going with it?
Could I make more money elsewhere?
Okay, good. That's what I wanted to hear. So talking about opportunity costs. So Ryan said what were kind of the interest rates at that time. Can you add to that? I don't know if interest rates would necessarily be the appropriate thing to look at. But you're almost there. And I'm just thinking, when you said interest rate, I'm thinking of bank rate. So if the banks could loan you at 6%, is that what you were talking about, or what were you talking about?
More of investment rate. If I make 5% doing this, or I can make 10% doing something else.
Good. And that's what I wanted to push you on. So that's the type of rate we'd want to look at, right? Your opportunities. What are your other opportunities? Now that might be a very personal decision. If one of your opportunities was to put it in, your best opportunity you thought was to have it in a money market mutual fund earning 0.000005%, then that would be your opportunity. But if you had other real estate investments that you thought were pretty good and you could have parked them there, and you looked at 5 or 6 of them, and on average they tended to be, make up a number, 10% after you've done some careful analysis, then maybe your opportunity cost was 10%. Which means, to make this a good investment, the right choice, we've made a good decision, what do I need to be earning on this investment? If 10% seemed to be a reasonable average for this type of situation, we need to get that, right? We need to get at least the 10%. So that's kind of the direction we're heading. All we have to work with, though, are the numbers. All right, so how do we calculate the value of future payments? Which one's more valuable, the year 2's payment or the year 1's payment? Year 1, right? So that's the first step to this, is to really believe it in your gut that there's a time value to money. Hopefully that'll make sense as you start to think about opportunities, because there was lost opportunities. That's why you'd rather take $5,500 today versus $5,500 a year from now, is because if you got it today, you could invest it in something and have more than $5,500 a year from now. Okay? So, everybody clear on that? Now, the more difficult part. What would we have? So let's do a kind of a side example. So if you earned 10% on $5,500, how much would you have? How much would you have in 1 year? And by the way, you'd still have your $5,500. So I'm kind of thinking of a side example here. This is just a cash investment. You put in $5,500, you earn maybe from a bank, or somebody's paying you 10%. Maybe it was somebody with other opportunities. It was that 15% opportunity cost guy. You gave it to him, he gave you 10%. How much do you got? 61. How'd you get it?
10% times 500, and your original principal.
Okay, hold on. 10% times 5,500. I got my equation goggles on. I'm translating into my language now as you go. So 10%, 5,500 plus, or in what?
Equals.
No, I'll do the translation. You were doing beautifully. I just interrupted you and myself. 10% of 5,500, and then you keep talking. Plus the principal. Good. That's what I heard. Sorry I interrupted you. Okay, and then you get the equals something, which you said is 6,100. Is everybody okay with that math? Mm-hmm. Right. So this is how much? 550. So 10% times 550 plus the 5,500 back gives us 6,050. Okay, good. Now, no, you're doing fine. You're doing fine. I really want to walk through. I want you guys to mentally be able to walk through and do the exact same thing. You need to be able to translate that into a formula. So look at what we got going on here. So here's today's value. Here's the future value, right? So I'm going to do a little bit more math wizardry and suck out this 5,500 because that's legit, right? So if I take 5,500 times 1 plus the 10%, everybody agree with me that that's legit maneuver? All right. So now we're starting to get somewhere here where we've got a present value being converted into a future value. All right. So what if we let it ride a second year? How much money do I got? So the guy comes in, he says, hey, I got your money, do you want it? And he's like, well, don't you want it to keep going? And he's like, sure, yeah, I could do it. So you let the 60-50 ride another year. Okay, 6,655. You got that by doing what?
That equation, but to the second power.
Okay. Oh, you did that. You went to powers already. I want to slow down.
That's just how I looked at mine.
No, you're fine. We're gonna get there. We're gonna get there. So I'll come back to you. What did we effectively do with this number? That's our new principal. So 60-50 came down here times 1 plus the 10%. So we got 10% on this number, $605, right? So we got $605 plus the 60-50 gives us the 6,055, right? 6655. All right, now it's okay to memorize what Gabby did because she came out with the right answer, which is good, but having a deep understanding of it's even better. So what I want to do is do a little bit of substitution with you. Do you see something going on? I got two equations. This chunk here, this chunk is actually this. So if I go put this chunk in here, I've got 5,500 times 1 plus 10% times 1 plus 10%. 6655. Now what do we got, Gabby? This could be simplified by doing what? To the second power. Right. So we've got a like term. X times x is the same thing as x squared. So now we've got 5,500, which is the way Gabby did it to begin with. 1 plus the 10% squared equals 6655. All right, I like to spend a lot of time with this because it is the mother of finance. I mean, this is the mother child here of finance. I don't want to go too deep here. Present value, future value, that's it. We've done everything that you need to know. Well, maybe there's a few other little tips and tricks if we get into monthly interest and stuff that we could do. But this is the basic concept. So notice what we have here is we have the present value, right? So we got the present value of 55, I'll rewrite it up here, 5,500 is equal to the 1 plus the interest rate, the 10%, 1 plus I, raised to the 2 power, which in general would be the n power, the number of years, and that all equals the 6655, which you guys already have written down, and that's our future value. So this is how we convert a present value to a future value. And this is not an equal sign here. The present value times this chunk, sorry, equals the future value. How we doing, Jesse, Denise?
Good. I had to learn some of this stuff for my CPCU license for insurance.
This, if you're an MBA student, it would be an embarrassment in a job interview if you could not do this formula. This would be another one that I'd really like you to have with you the rest of your life. You should be able to explain it just like I did to somebody. That's not hard, right? If we work through the investment, I usually make it easier with my undergrad students. I take $100 at 6% or 10% so that we've got real easy numbers. You guys got the sophisticated $550 here, but I knew you could pull it off. So this is important. You got to really understand this rather than just having it memorized. I know some other professors, have you use either the tables or just the calculator. I want you to know the formula. It's not that hard, and it really adds to your sophistication of how you should think about things. You might not necessarily pull out this formula, but your mindset needs to be there on tackling that problem and why are we using this formula to bring back future values. All right, so now we can show the present value of future sums really easily now. The present value is equal to the future values divided by this little chunk. And that's it. So we got two little catches that can get you sometimes that you got to be careful of is n is the number of years, assuming this is the annual interest rate. With the whole thing is talking about annual compounding. Annual compounding. Once you really understand that and buy into it, it's really easy to change this into monthly, which is the most common thing you do. If you're doing months, you just have to make these two things match. So if this is a 10% interest rate, the monthly interest rate would be 10% divided by 12 to change that into a monthly interest rate. And if it was 5 years, it's now 60 payments. N is the number of months. So you convert the years to the number of months. So always make these two things match. It's all the thing you got to remember. If you're trying to calculate the monthly payment for your car, then this has to be the monthly interest rate when you do this calculation. And now you'd be calculating monthly compounding instead of annual compounding. All right, questions or comments there? We haven't even got to the fun part yet. Here we go. How do we analyze the present value of this investment? What is the present value of our little scenario we've got dreamt up here of time period 0, which I didn't put up here yet because I like to think of this as time period 0. When's that? That's today, right now, when the decision is being made. The decision's being made today, and this now is our initial investment. We're going to cough up $74,000, and in return for doing so, we expect to get $5,500 here, $5,500 here, $5,500 plus 75 because of a little uptick in value that we expect to have on that little duplex that we bought in Ottawa. After paying property taxes, I might add, right? We will earn $5,500. So that's pay 74, all the operating expenses. This is the marginal benefit in time period 1, time period 2, time period 3. So, how do we use that formula to get the present value. So the question is, here's the big decision. Should I invest $74,000 given those expected returns? Should I invest? It's a simple yes or no. Buy it or not at $74,000. You've done the negotiating. This is the bottom dollar that the seller will go. Should I do it? It's time to pull the trigger. The realtor's saying it's a great deal. Do you think it's a great deal? All right, so who's got thoughts on how we analyze these animals over here? I know for sure I'm going to spend $74,000 today. What do we do with the first $5,500? What do we do with the, I'll give you a hint. There's no magic formula to be able to plug this into and have all of this solved out at once. It's going to be one long thing. So it's okay for you to chunk it up into pieces. How do we value that first year's $5,500 payment? What do you got to do?
Let's find the present value of $5,500.
Good. So what do we do?
Present value equals
Okay.
future value
Okay.
divided by 1 plus the interest rate.
Which is?
Are we saying 10% still?
That's what I was hoping we'd say, but why are we saying 10%? Ryan, I'm going to put you on the spot. Why are we saying 10%?
Opportunity.
That was our other opportunities. We did an evaluation. We thought that, hey, I should be able to get 10% on a property like this in Ottawa, Iowa, or Ottawa, Kansas. I should be able to get a 10% return. So that's why we're discounting. That's where that discount rate came from. We're going to discount that future value by that amount. So 1.1 raised to the 1 power because it's 1 year out. 5,000. Year 2. Now I always like to pause and really think about this one. So this one's 5,500 divided by 1.1 raised to the 2 power, and you came up with what for? 0.45. Okay, we'll call it 46. That's good enough. There's the power of discounting. Doesn't that start to speak a little volumes of why we treat dollars differently? So this 5,500 is worth 45.46. This 5,500 is worth 5. In terms of what? In terms of what time period? 0. Time period 0. Today, the present value. So what we're doing consistently is we're going to take this number and go back in time. We're going to take this number, we're going to go back in time. How do we go back in time? We're going to pull these back by using that formula. So everybody pull out a sheet of paper and a calculator. You can write on your notes. I'm not going to have you turn this in. But I want you to pull out your calculators and do that last calculation yourself. And I will come around and I'll come to you guys last in Overland Park.
We're trying to find for year 3, what is it?
For year 3, what is it?
No, we purchased the thing in year 0. Are we expecting to sell it?
Yes. We're expecting that in year 3. That's what the 75,000 was. We're selling it. We got 75,000 net was our benefit. Maybe we sold it for 80 and had to pay a doggone realtor 5,000. I don't know. Whatever. But that's what we're getting in year 3. And what's that? We've made that expectation, yes. And we believe that that's a reasonable expectation based on property values at the time, that appreciation would go up, but then there's realtor costs, and we've thought about it, yes. That's what I want to see. You guys be brave and work on it. Okay, you guys can hold your papers up to your individual cameras, Jesse and Denise. I can see you on the close-up camera, so just when you're ready. Just tell me you're ready when you're ready and just show me what you got. Probably write down your work first before you hit the calculator, just so I can keep you on the right track.
Yes or no?
Okay.
Right track or no?
Yep.
Okay.
Yep. Okay, you need a little bit more. This is okay, but it's short. This is okay. You got it. I guess I'm not sure what you did here, but this was okay. This is the right number to use.
That's just
Is that raised to the power or whatever?
Yeah, to the third
To
power.
3, yeah. Show your work on that, but yes, that's fine. Okay, what are you doing next? Show the rest of that. Finish that line. Okay, now that's okay, and that could be combined together.
Okay.
But that is fine. The math will work out either way. This part's okay, but it's not enough because you need to take both into account. Okay. And you can add them together. You can do the computations separately. Same thing for you. Okay, yeah, go ahead. So that's correct, but that could be combined to adding those together direct and just dividing it by 1. It could be simplified. All right, Overland Park, let me check you out here. Where you at?
Okay. I don't know if you can see mine.
Yeah, I can see it. Pull it back a little bit further. Oh, hold on, now freeze. You're right. Hold on, let me just click the screen and make it bigger.
I can rewrite it.
No, I can see it now. You on your 5500 where you divided by 1.13, you also needed to divide it, add the 75 into that. Okay, so that last term. Let me look at Jesse's. So Jesse, that's fine for the 5500, but you're missing the 75.
I am too.
Yep. So both of you two, that's the correct computation for the 5500, but you're also going to bring the 75 back. So let me show you up here.
Okay.
Unless that's part of what you did, Denise, with the, no, you just added them together. That's not correct.
Okay.
You need to, so Denise, up here, I was able to just kind of point it out to the others here. So take both of these terms and add them together. That's fine. So then you've got 80,500 divided by it. Or you could do them in separate chunks, but you just have to make sure that you apply that logic to both terms. Either way, it's going to map out to be the same, and you're going to bring that back.
Oh.
All right, so you guys are all on the same track. Should we do it or not?
No.
Why?
Because when you add it all together, it comes out to less than what you're using.
What did you get when you added them all together?
70.
Even?
No.
Give me an exact number.
Oh, it's 70,000. I could be wrong.
70,000 what? 26. Did other people calculate that? Gabby, you got that?
Yeah.
Did other people do it? That's what you need to do. You should be doing it if you didn't. You need to add together all 3 of those chunks. Did you get close to that? Okay. All right, so let's take Skylar's word here. It sounds like he's got a couple other backers. What is this really saying? It's saying that if you gave me this deal where you're going to give me 5,500 after 1 year, 5,500 after 2 years, and 80,500 after 3 years, what I value at that, because of other opportunities I have in my life, I put a value of $70,000 on that. So, is it smart to pay 74 today? No. Right. So, the rate of return is something less than 10% is what that's telling us. So, here's the net present value, which finally brings us back around to a lot of things they're going to take for granted over here, the net present value rule. So the net present value is equal to the present value of the future income stream, which we just calculated. We call it an income stream since there was a series of payments. The present value of the future income stream minus the initial investment, which is today's marginal cost. I can't remember if this textbook does it, but this was our initial investment that would have been required. Initial investment. The net present value ends up being a positive number or a negative number in this case? Negative. That's the present value rule. So back to the screen here. If the present value of the net cash flows is larger than 0, the project is profitable. If not, don't do it. By virtue of what? By virtue of your other opportunities. Now we've rolled in the economics into it, right? Because we plugged in 10%. I can pretty much guarantee you if you would discount these by 2%, then it would be a go. The present value of that future sum, because check it out, if you just take simple math, which is not the correct thing to do financially, but just bear with me, 5,500 plus 5,500 is 11,000 plus 80,500 gives us 91,500. Well, geez, 91,500, and you only have to pay 74 for it today? That's a go, baby. That's 20,000. Do most people think that way? Yes, most people think that way. Most people think wrong about that investment decision. So now you guys are thinking right about that investment decision. Think about your other opportunities, factor that into the equation to make a good decision in time period 0. When's that? Today. Should I buy it? Should I not? Should I invest this money? No. The net present value is less than 0. All right, Jesse or Denise, questions? All right, you guys will have time to practice a little bit more of those skills later too, but that's an important one. All right, here's another quick one that I won't spend too much time on since we just did this one. Outflow of cash, inflow, and then this is just kind of your net of the two. So we give up $100 today, we get 115, we get nothing in year 2, we end up having a positive 15. Kind of the simple way of thinking about things. 100, 60, 20, we got a net benefit of 20. What is it really going on if the cost of capital again is 14% or whatever your opportunity cost is? That 100 turns into 100, or 115 turns into 100 going back 1 year. This $60 turns into 46, making both of them pretty sucky. If your opportunities were 14%, which is probably pretty strong, but it flips the switch is part of the reason this one's showing up here. This one looked better than this one when you did a simple sum, but when you take into account the fact that you're getting most of the money in year 1, that's what made the difference here. You're getting most of that money, that $15 benefit is coming in year 1 rather than spread over two years. Okay. All right, so the last thing I want to bring up on this topic is something called the internal rate of return. And again, I'm not going to spend too much time on it. It's connected to this. And so You can do this on an Excel spreadsheet. You might have seen this calculation in other things. All we're going to do is, instead of assuming we've got a 10% opportunity cost and doing this, we're going to use a computer to solve for I. If you guys look at your sheets that you worked out, you had that 1.1 here plus, if we wrote out the whole formula, plus this chunk, which has the interest rate, plus this chunk, which has the interest rate. The computer can go through an iterative process. It can't solve it algebraically, by the way, so you can't solve for I with these exponents. And it will come to the solution of what I was. And that is your internal rate of return. And then the decision making ends up being similar. If you have an opportunity cost of funds that you feel is 10%, and the internal rate of return turned out to be 7.6%, do you do the project? No, right? So the internal rate of return was less for this project than what I could do with other opportunities, then I don't do it. In other words, these two things are consistent with each other. It's just that one you're solving for the present value, and technically the net present value. This one you're solving for that interest rate. So they're kind of kissing cousins to each other. All right. So a couple other little tools we're going to have in our box. So sometimes businesses might think in terms of quantities. Sometimes they might think in terms of price. Well, what do I need to sell to break even, right? How many units do I need to sell to break even? A lot of executives and other decision makers will think in those terms, in terms of quantity. And so we can calculate that using the stuff that we've been doing. You have some fixed costs associated with selling your product, right? You've got some variable costs that's related to the cost at the margin. So these, in this case, we might be assuming a fixed cost, but bear with me. So how many units would it take to pay my fixed costs, right? That's what the break even would be. I'm going to have a certain amount of fixed costs, and how many would I need to sell to pay for all of the fixed costs? By doing so, I have zero profit. That's the break-even part, right? If I'm just paying all my costs are covered, I'm covering all of my variable costs, and I'm covering all of my fixed costs, but there's not a cent more. That's why we call it a break-even analysis. And so this term here is often called the contribution margin. How much more is an additional unit being sold contributing to the bottom line, the contribution margin? And so that's the difference between price and marginal cost. Questions or clarification on that? The math turns out to be fairly easy when you get in it. You got the formula here. So example here with Nissan trucks. They did an analysis and came up with $400 million to redesign the Titan. This is a real story, by the way. And so should we do it? Should we not? The cost of capital is 12%. That would imply having some fixed costs of $48 million by taking 12% of the 400. Each truck brought $1,500 to the bottom line. But that bottom line was due to the redesigning fees, which was variable at the time before the decision was made. You with me? So I'm thinking, should I design this truck or should I not? If I do so, I'm going to pay engineers, design people, marketing people, whoever we add to the list. I'm going to pay $400,000 of fixed cost from that time period. Each truck brings in $1,500. How many would I have to sell? Well, it's just the $400,000 divided by the $1,500. We'd have to sell 32,000 trucks. So then the executives thought, well, wait a second. This was kind of the no-brainer, double-check your gut. We only have a 3% market share, which is about 12,000 trucks. There's no way in heck we're going to sell, even if we redesign something that can maybe fly. Well, maybe they could then, but whatever design we come up with, we're not going to cover that, so we don't do it, right? So that's how we can use quantity analysis I'm not going to get to the golf clubs today either. All right, so then they ended up going a different route. They were able to license out the Dodge Ram truck design and kind of tweak things. Very common thing of the automakers that you might be aware of. If you go up to Canada and they call it a different name, but they've taken the chassis off of a car and tweaked a few things and called it something different. And so the car companies can even go across lines. Usually they keep within their own company for that. But okay, what about with price? You know, what do I need to sell the product at? So maybe there's some uncertainty with price. Maybe in the truck market, it's a little more known what we're going to sell the truck for. But maybe in other circumstances, if we're selling cookies or Frisbees or soda, well, soda might be bad, but some sort of unique product, we don't know. So what's the minimum price that I need to get to break even again? And so if I think about the cost I have to take on, it's going to be connected to your variable costs, right? So whatever those are. Now in the Titan truck case, that was a kind of a variable cost going into that decision. But otherwise, it's truly just the cost. So if you're thinking about entering a new market with your cookies, and you already got the machines that bake them, and you've already got trucks that deliver them, don't include those costs, right? So only the costs that are relevant to the decision, and calculate out what your price, what's the minimum price you should have. Turns out you need to look at the average variable cost, which in this case we're going to recharacterize as an avoidable cost, right? The Titan truck, it was a fixed cost once they did it, but before they did it, it was avoidable. So we got a little bit of a different breakdown that's really a reworking of what we talked about before. So this was that taxonomy of costs that I mentioned earlier. So you've got all your costs of doing business. We did the Hy-Vee grocery store. What's avoidable? What's not avoidable? What's unavoidable? What's gone? What's paid for? What can't be recovered? So let's start by thinking about avoidable and unavoidable costs. Again, part of that could be the Titan truck, which appears to be a fixed cost after you've made the decision, but before the decision, it's avoidable. So truly, fixed cost and variable cost can potentially be avoidable in the decision-making process. Once you bite the bullet, then you're stuck with that decision for some period of time. That then distinguishes long run and the short run. Okay. Questions, Overland Park at all? All right. This is a little simple one. Fixed cost, $100 a year. Marginal cost, $5 a unit. Quantity, $100 a year. What's the break-even price for this scenario? What's the minimum amount we need to get to break even? It's a little tricky, so be careful. You've currently got fixed costs of $100 a year. You've got marginal cost of $5 a unit. It's constant at $5. What's the minimum price you need to get to break even? Do we include those fixed costs? No, we don't. So the break-even price of that venture, we've already paid for the cookie ovens, we've already paid for the delivery trucks or whatever. We're going to ignore that. Hey, if we can get at least $5 for this new product, we'll break even. We're covering our marginal cost. So that would be the break-even price. Now, we can't go on forever just pricing at the margin. We actually have to pay for our fixed cost eventually. So then we start thinking about long run, short run, and if we sorry, I didn't mean to do that on this one. In fact, we're not going to go through this one, but very similar problem. But we would need to cover that $100 eventually, because in the long run, we have to at least break even with economic profits. We can't have a loss. If we are only covering our variable costs and never chipping away at our fixed costs, you're losing money, right? I mean, that's losses. You might be able to suck it up for the short run, but over the long run, when you have the opportunity to change your trucks to change your pizza ovens, to change your cookies, to change your everything, and you still can't make money, guess what? You should be doing something else. Right? You get out. So that's the long run decision. So in the long run, we need to cover all of the costs. So in the long run, price equals average cost. As we get into the next material on looking at industries and kind of the relationship with other firms, that'll become important. Right now, we're just trying to get those building blocks down. Hey, I need to cover all of my cost, at least in the long run. Hopefully, I'll make lots of money. But at a very minimum, I have to cover all of my average total cost compared to my price. My price and average total cost have to be at least that. In the short run, I can suck it up if I cover my variable cost. But in the long run, I got to cover them all. All right. Let's call it a night.